prices of residential real estate have really screamed higher to the levels where they may now be overpriced and due for a correction. But as the ECB is forced to raise interest rates because of the inflation that it's trying to combat, the places like Italy, like Portugal, like places like Estonia, where a lot of the residential mortgages are floating rate, they might actually experience a materially higher cost of capital that impacts the monthly bills. So this is why I do worry more about the adverse impacts of higher rates and higher energy prices on the Eurozone. So I think we've priced this in, to your point. That's why Euro is a parity. But I don't think it breaks away from that anytime soon. I mean, if you think about the growth differentials, if you think about the interest rate differentials, we're talking about almost 3.7% on the U.S. Fed funds rate by the end of the year.
Yeah.
We're looking at maybe 1.15 for the euro in the next 12 months or so. So that's quite a gap that's still going to favor the U.S. dollar.
This is incredibly important, Anastasia, especially because next week we find out whether Nord Stream 1 comes back online and the gas input from Russia is what it was pre-maintenance. How much does the euro rally actually versus the dollar if it does come on and Russia does continue sending gas to Germany and the rest of Europe versus the downside if they do not?
Well, I think it would be a relief for the euro, but I would have suspected it's temporary relief because I think the biggest thing that's really dictating the value of the euro is, once again, is the interest rate differentials and it's the growth differentials. And, if the gas does come back on, I think that's a short-term relief. But the reality is oil is still around $100 a barrel, and I don't think that's going to change anytime soon. So that's still going to squeeze the economy.
Anastasia Amoroso, thank you so much for being with us. Have a great weekend. Coming up, the market-moving events that you need to be watching. That's next in our trading diary at a time when we are trying to claw back some of the losses from a week where recession was the main theme. From New York, this is Bloomberg. This is Countdown to the Open, ending the week with a breath of relief with a gain for the S&P up 0.7%, 0.5% for the NASDAQ. What you can see in bond markets is stasis. You are not seeing a huge rally. You are seeing a bit of a sell-off, although that's actually gone into a rally as people parse through the data. The 10-year yield now down to 2.95%. The 2-year yield up as people talk about the potential for perhaps more aggressive rate hikes, which is why the yield curve has been the most inverted started going back to 2000, the year 2000, and that is leading to a lot of concerns about what we might see in the economic outlook ahead. Time now for the Trading Tire, what you need to be watching in the week ahead. The University of Michigan Consumer Sentiment Survey coming at the top of the hour, plus Fed speak from Mary Daly and President Biden landing in Saudi Arabia later in the day. Next week, Bank of America and Goldman Sachs both reporting results on Monday. Netflix earnings coming out on Tuesday. Rate decisions from the Bank of Japan, and key to watch, the European Central Bank on Thursday as they face off between a rock and a hard place, trying to raise rates into slowing growth and an increasing likelihood of recession. This was Countdown to the Open. This is Bloomberg.
From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It is 30 minutes into the U.S. trading day on this Friday, July 15th. Here are the top market stories that we're following for you at this hour. I'm still shopping. Retail sales, Trump estimates, consumers hanging in despite that rising inflation. Up next is UMich. We're going to break it all down with PIMCO's Tony Crescenzi, Joanne Shu of the University of Michigan, and former Fed Governor Randy Kroszner. Bullard sees 4% rates this year. The Fed bull says the central bank might have to hit that 4% by the end of the year. Talks down the possibility of a recession. Two-year yields move higher. And Biden's historic visit. The U.S. president will touch down soon in Saudi Arabia, marking a huge shift in relations with the country, even as hopes for more oil reportedly slip away. From New York, I'm Alex Steele, my co-host in London, Guy Johnson. Welcome to Bloomberg Markets. Guy, let's get right to it. UMich coming in slightly better than estimated.
Absolutely, certainly at the headline level, plus you've got an inflation drop, which I think is significant. So the headline number, 51.1, that's up from 50, survey 50, so that's better than expected. Current conditions, 57.1, that's a very strong number. Expectations going forward, 47.3. Dropped a little bit, but not changed much. 1-year inflation, 5.2. That's down from 5.3. The big drop comes in the longer-term story on inflation. 5 to 10 inflation drops to 2.8 from 3.1. It's that last piece of data I suspect the market is going to pay attention to, but the consumer seems to be in pretty good shape right now. Let's get some insights into the numbers. UMich, now an A-grade data series that we're all focusing on. Joanne Shu, University of Michigan Surveys of Consumers Director. She crunched the data. Joanne, how should we be reading this data? How should we be reading these numbers?
So when I look at the numbers, what I see is that not a whole lot has changed between June and July. You know, it edged up a little bit, but it's within the margin of error. And essentially, consumer sentiment is pretty stable within these 2 months. In a sense, that's good news because it had been declining quite a bit over the last year. So any sense of stability is a good thing. But at the same time, the levels of each of these components of the index, how people see their personal finances, their assessment of the economy going forward, all of these things are still really close to historic lows. So all in all, sentiment remains low.
Joanne, the market's going to take that drop in inflation expectations as a sign that the Fed may not have to move as fast as they thought last time we got the UMich read. Is that the correct read? And I guess I'm asking just how sticky that drop in expectations for inflation is.
So over the last 11 months or so, 5 to 10 year inflation expectations have remained between 2.9 and 3.1. It's 2.8 this month. The last time it was 2.8 was about a year ago. What seems pretty clear to me is that consumers are reacting to a lot of different pieces of information, including gas prices. Our data on gas price expectations also went down quite a bit. At the same time, though, while the inflation expectations appear to have improved, people's assessment of their living standards, of their personal finances have not improved, and inflation remains on the forefront of consumers' minds. They about half of all consumers are blaming rising prices, inflation on for eroding their living standards. So in spite of this recent improvement in expectations, consumers are still telling us they're in a lot of pain.
Okay, I just want to focus in on this because the S&P has reacted fairly strongly to this. You've seen a spike upwards in the S&P, particularly on that 5 to 10 inflation number. In terms of how volatile you think that number is going to be going forward, how should we be thinking about it? Just sort of drill down into your kind of sense around how that number is going to evolve, how it is evolving. You talk about the fact that the consumer's in pain. The market is looking for any reason why the Fed should not be more aggressive here. Is that a good enough reason, Joanne, for the Fed to maybe take a more cautious view, maybe not to front load, maybe not to deliver 100 basis points in terms of hikes?
I mean, the Federal Reserve is going to be looking at these numbers alongside a lot of other numbers. What I can say from the Michigan surveys of consumers is that, like I said, 2.8 is where we were about a year ago, 2.9 to 3.1 over the last year. This current reading is a preliminary reading, and we really need to see going forward how sticky it is. I would not assume at this moment in time that these expectations are sticky. Certainly there is some response to, what we're seeing some evidence of people citing relaxed supply constraints, for example, in their assessment of buying conditions for durables. But at the same time, we also have an uptick in people who think now is the time to buy durables because prices are only going to go up. So the main thing to remember here is that while this median number has dropped down to 2.8, what it reflects is an enormous amount of uncertainty. We have quite a large jump. We had a large jump last month, and this jump continued to this month, of people who expect long long-term inflation to be zero or even negative. And that's not an optimistic view at all over the trajectory of the economy.
So Joanne, what I'm getting from you is just like take this number with a grain of salt in that it can change and that consumers are still quite nervous. There's been a lot of talk in the market about we're talking ourselves into a recession. And I'm wondering, when you're looking at the numbers that you guys just released, you get the sense that consumers are also going to be talking themselves into a recession?
It's pretty clear looking at the 1 year and 5 year business conditions expectations that people are expecting a downturn of some sort. But as we were seeing with inflation, there's a lot of uncertainty here. Certainly, our consumers are talking a lot about the bad news that they hear on the news. They're hearing a lot about recession risk. They're hearing about a lot of these things, and they're mentioning that those risks to us in the survey. So, given that we've seen a lot of pessimism on the economy, with a little bit less pessimism on their own personal finances, which, although they're historically low, their income expectations still are still fairly strong, though they have softened, and so there is certainly some influence from the public discourse.
Yeah, that's really interesting because because Jim Bullard, talking over the last few minutes, talking about the fact he says, this is a quote from him, it doesn't feel like on the ground like the U.S. is in recession. To Alex's point about talking ourselves into a recession, is there what does the historical data tell us about how consumers react to the information they're getting and whether they overreact or underreact? I'm just trying to get a sense of unemployment still looks fairly good. Waller was talking about this yesterday as well. It is unlikely that we are in a recession with this level of unemployment. Why is the consumer so pessimistic at the moment? Why are you getting that from your surveys?
I think we have to listen to what the consumers are saying, and the main thing is that they feel like high prices and inflation are eroding their living standards. What we're seeing even on labor markets is that there's actually an increase now in the share of consumers who believe that unemployment is going to go up. Labor markets have been really a source of strength for the economy and a source of confidence for consumers, but we're starting to see initial signs of that cracking a bit. We still see a majority of consumers believing their income is going to increase over the next year. But for the first time in over a year, that median increase is now less than 1%. So even in these areas where we expected a lot of strength, consumers are expecting some weakening going forward.
Joanne, one more quick thought on the labor point, because as Guy pointed out, as Waller said yesterday, if you're 3.6% U3 rate, that's not a recessionary indicator. What we are seeing, though, is that crunch in real wages, and that on a real wage basis, we're losing like 4% now because inflation is so high. Do consumers expect that wage crunch to continue? And I'm wondering how they feel about having the power to go back to their employer and say, you got to hike my wages to compensate for that 9% inflation. Are they doing it? Are they seeing it?
So they are absolutely 100% seeing the crunch in real wages. I don't have a really good sense from our data whether consumers feel like they're able to increase their income by going to their existing employer. Certainly the tightness of the labor market, and particularly their expectation, their previous expectation that unemployment would remain really low, suggests that consumers would be able to get higher salaries, at least by being able to find a new job fairly easily. But with the softening of labor market expectations, it's unclear whether consumers expect to be able to do that going forward.
Joanne, this was such a great conversation. We really appreciated breaking that real-time data with you. It's such a treat. Thank you, Joanne Shu, University of Michigan Surveys of a Consumer Director, and everyone really highlighting here that 5 to 10 year inflation expectation now at a 1-year low. So coming up, more on that latest read of the economy, what it spells for investors. PIMCO's Tony Crescenzi will be joining us next. This is Bloomberg.
Bloomberg.
Season is coming.
It's a low bar going into earnings season.
There are bargains out there to be had.
Bloomberg is fastest with the numbers and analysis.
Conflicting and complex cross currents.
Strap yourself in for this earnings season.
Bloomberg, the fastest numbers and analysis you trust.
I worry about the recession later in the year and next year. That will be more significant. If we're in a recession right now, it's mostly an inventory and a trade cycle, pretty damp. But it might just mean that the slope's going down to the more significant problems we have later in the year as the Fed tightens more.
That was Vincent Reinhart, Dreyfus and Mellon chief economist, speaking earlier on Bloomberg Television. Jim Bullard, though, disagreeing, says no signs of a recession. They see about 4% potentially in terms of Fed rates by the end of this year. Joining us now, Tony Crescenzi, PIMCO Executive VP and Market Strategist. Tony, the data we got today, retail sales, UMich. What does that mean for the Fed? 50 bips, 75, 100 bips?
Well, you're seeing commentary that's all over the place. In the end, if you're long-term oriented, you really shouldn't care. What you care about is the Fed's verve and determination toward extricating markets from this dilemma on inflation. And clearly it has the determination and all of the abilities to get rid of the problem. It's more likely to be in the 75 realm, but it could easily move to 100 because the Federal Reserve has made clear it wants to get to what it thinks is neutral quickly, and that neutral rate is a point away, so it's possible. But as some Fed members are saying, other things could happen along the way that they're unknown, and so perhaps they want to be a little more ginger. One final word, though, is 55 days between this meeting, the end of the meeting coming up, and the next one. Yep. That's longer than we've seen recently when it was around 42. So given that there's added time in between, who knows, maybe the Fed will decide, let's do a little bit more now in case inflation data stay bad. Who knows?
Tony, I'm hearing a number of Fed officials over the last few days downplaying the risk of a recession. Bullard's been on the tape over the last few minutes. I take the yield curve inversion seriously as a signal, but I think it's different this time on the yield curve. If inflation was at 2%, the inversion may signal a recession, but we're not at 2%. We had Waller yesterday saying, we got unemployment so low it can't be a recession. What do you think of those comments? The Fed clearly doesn't see the economic clouds forming and getting worse, certainly over the near term. Do you think they should be more worried, or do you think they're right to be as worried as they are, i.e. keeping an eye on them, but not that concerned?
Well, in this recession obsession at the Fed, in the financial markets, et cetera, the commentary is everywhere. What seems to get lost is what type of recession would it be? And I think in some of the commentary you're starting to see this idea that perhaps it won't be so bad. And so this idea of a hurricane, for example, is probably the wrong idea. Probably the right idea is a light rain, steady perhaps, because the fiscal and monetary authorities won't be able to do much when there is a recession because they've kind of run out of ammunition. The Federal Reserve will want to reinforce the credibility it's established since the Volcker days when Volcker had to reestablish Fed credibility. And when we think about the pillars of the foundation for the economy, the macroeconomic story looks pretty stable. Mm-hmm. Sure, we can reach a recession, but as investors, we have to think about what would it look like and what's on the other side of it. And it's seeming like it's likely to be mild.
So, Tony,
lots of reasons for that.
Tony, where's the biggest misprice in the market? So if we take a look at the equity market, yeah, we're up today, but Deutsche Bank's Jim Reed said that treasuries on the 10-year should be below 2% if you take into account any cross-asset proxies because the S&P has been hit so hard. Copper has been taken out to the woodshed. Where are we mispriced for the scenario you're laying out?
Markets probably are relatively appropriately priced to an extent, but the idea of a sub 2% 10-year would require a much different set of economic conditions, probably a deeper economic recession than market participants might foresee, because the main components of the yield, of course, is three of them. It's the inflation rate, the term premium, and then what the Fed thinks it should have its policy rate at relative to the inflation rate. And with a 2.5% plus type inflation rate ahead of us, as far as we can see, on the term premium likely to rise, meaning the extra yield a bond investor wants for moving out on the yield curve, that likely rises as the Fed steps back. It seems unlikely yields will get back there. And final word on that is the memory of what happened in the bond market this year will last for even a generation, and so investors won't be so quick to drive yields down that fast. But there's likely a period of stability, and we've had it since April.
Can I come back to the light rain, or as we would call it, drizzle?
Oh no!
Back to the weather. How long does the drizzle last for? That's what I'm curious about. There seems to be this assumption that the Fed raises rates and then cuts them relatively quickly as the recession starts to appear. Do you think that's the case? Do you think we could go up and then stay up? Because it's the staying up bit that establishes credibility. Bullard's talking about getting 375 to 4 probably by year end. Do you think that the Fed needs to keep rates higher for longer than the market is currently anticipating?
It's a good point. It's a good point, Guy. In fact, that seems to be a reasonable case. Think about it this way. Baby boomers like me, born between 46 and 64, were the only ones that thought inflation could ever accelerate until the recent episode. Now you've got the millennials, X, Y, and Z, all who believe that the inflation rate can go up. And so the Fed has to be really careful about letting inflation expectations get back up again once they get down and you see they're starting to move in the right direction. And the economy has the wherewithal to improve when recession hits. The household balance sheets, you've heard that story about excess saving, $2.5 trillion above the long-term trend line. Household net worth, $150 trillion, $50 trillion more than 5 years ago. Take $10 trillion off that because of the stock market decline recently, but still pretty good. And also the banking system's extremely strong. The Fed in a stress test last month, supposing a 55% drop in stocks, 40% drop in commercial real estate prices, 10% drop in GDP, 10% unemployment, still had banks with capital levels twice the regulatory minimums, meaning money will flow to entrepreneurs, innovators, inventors, and credit-worthy borrowers in a time of stress. So lots of reasons to think we can come out of this pretty good. Lots of investments on the way from the green transition, the supply chains, et cetera, and finally, there'll be investments simply to reduce costs in technology, most likely, the rest of this decade.
Hey, Tony, next week is going to be a key week over in Europe. Not only are Italian politics blowing up, but you have Nord Stream 1 to maybe come back online on the 21st and the ECB meeting. If the outlook in the U.S. is, as you say, a storm, but not a hurricane, what happens to the ECB? How much can the ECB actually hike?
Well, the European Central Bank has a single mandate to fight inflation, whereas, of course, the Federal Reserve has a dual mandate to fight inflation, but to balance it against wanting a low unemployment rate that, of course, is both that reflects inclusion as well. And so the ECB will have to react to inflation data, and it will react in an odd way relative to history, looking at food and energy prices. This is something we haven't seen before, because when food and energy prices move up on commodities in general, the central banks typically say, let's look through it. Let's look through these so-called supply shocks. But these days, because it's setting into inflation expectations, getting embedded there, they have to move. And so the European Central Bank likely keeps moving until the inflation rate starts to come down, or at least is clear indication that it will come down, and that inflation expectations are stable.
Yep. And then it's got to deal with the whole Draghi conundrum as well out of Italy. Tony, great to catch up. As ever, we really appreciate your time.
Alex.
Thank you very much indeed. Tony Crescenzi, PIMCO Executive VP and Market Strategist. Thank you very much indeed, sir. Okay, what have we got still ahead? BlackRock, State Street reporting earnings. We're going to look at inflows for their ETFs, or we probably should be talking about outflows. That subject next. This is Bloomberg.
right, ETF mega player BlackRock out with second quarter results this morning. You had client flows slowing, some pretty pessimistic language from Larry Fink. The stock down slightly in the market today. Is it all bad news, though? Bloomberg ETF IQ co-host Katie Greifeld is looking at some of those results. So the initial blush was pretty negative, but it seems like you had some more positive takeaways.
Well, if you look overall, of course, inflows did slow in the second quarter. But if you look specifically at the ETFs, actually BlackRock is sitting on net inflows of about $80 billion for their ETF lineup. And if you take a look at what actually was taking in money, you had IVV up there. That's BlackRock's S&P 500 tracking fund. That is going to take in money in almost any environment. Costs 3 basis points. Allocators love it. But if you look down the lineup at what's continuing to win, it's all treasuries. You have the entire yield curve represented from SHV, that is a bills ETF, and then you have TLT2, which is 20-year treasuries. So it's a very defensive tilt. It's a lot of bond funds.
Let's get back to the equities, though. I read your notes a little bit earlier. Fascinating. Single stock ETFs. That sounds like a contradiction to me.
It's a little bit of an oxymoron. You think a fund would have multiple holdings, but we did see the first U.S. single stock ETFs launch yesterday. Those actually already exist in Europe, guys, so you could go and get one yourself. But in the U.S., you saw the first 8 launch yesterday, and it was interesting. They're mostly leveraged, so that's the component here. And there's also an inverse component, too. One of the funds that launched yesterday was the AXS Tesla Bear Daily. So it's actually a way to short Tesla without actually having to short Tesla.
Well, that's what I was going to say. Are these going to be used more as vehicles to hedge other positioning rather than like an outright position?
It's a good question, and it's something that I actually spoke to the AXS CEO about, was who was this meant for? Is this sort of an institutional play? Theoretically, institutional professional money managers, they could actually just short Tesla themselves. He said this is for sophisticated active traders, and from just talking to people in the industry, it seems like this is really for retail players to maybe short some of these stocks without having to open up a margin account or go through those additional hurdles.
Okay, so let's just talk about that. Institution, you can see it getting pretty big. Retail, how big could it get?
It's a good question. I mean, we know that issuers really want to launch these things. We don't really know how robust demand will be because these have only traded for about a day. But if you look at the queue of how many funds could launch, there's over 80 filings for single stock ETFs right now. And we know that issuers want to launch these because it's a completely new category. They can still charge very high fees. If you look at the AXS funds that launched yesterday, they all charge about 115 basis points, which is very high for an actively managed equity ETF.
Yeah, absolutely. Katie, great stuff. Really interesting actually. Katie Greifeld on what is happening in the ETF space. If you want to get more, and this is well worth a watch, Bloomberg ETF IQ, Katie and Matt Miller every Monday, 1 p.m. New York time. What have we got coming up on this show? The St. Louis Fed President Jim Bullard says the Fed may need to hike rates to 4% this year. We will discuss next. This is Bloomberg.
About that all day yesterday.
We're about an hour into the U.S. trading session. Markets moving off of the UMich number with 5 to 10-year inflation expectations moving now to a one-year low. Equities around the highs of the session. Bloomberg's Kriti Gupta is tracking all those moves for us. Kriti?
Yeah, Alex, and that, of course, follows the giant move you saw in pre-market trading. We woke up this morning, futures were down. It came back up as you saw. Really, those retail sales numbers also moved the needle. So low inflation, strong consumer, at least that seems to be the narrative that's supporting these markets. And you are seeing that, as Alex mentioned, session highs almost up 1.7% in the S&P 500. The question, though, is it is Friday. Do you see a reversal of that in perhaps the last couple of hours of trading? We're going to keep an eye on that. The NASDAQ, not the outperformer, but still helping float that trade. Remember, you want big tech on your side to make sure the gains are sustainable, just given the massive weighting they've accumulated underneath the hood. And that's something that you're seeing over in Europe as well, up 1.7%. But remember, we have seen a series of down days as well. So how much of this is also perhaps just a little bit of a technical reversal? You can't even blame light volume here because volume is actually up on a 5-day basis. NYMEX crude in on that trade. Brent crude back above $100 a barrel. So that risk on trade, well, it is cross-asset indeed. Let's get to some of the individual movers here because in addition to all the eco data, you also got some major earnings stories. Citigroup actually coming out on top with a massive trading beat. Remember, JP Morgan did not echo that same vote of confidence. Citi getting a lot of the spotlight this morning. Wells Fargo, despite the rate hikes hitting their mortgage unit, they're saying we're going to keep those buybacks. That winning them quite the bid from the market as well. And take a look at this. United Health Group, their earnings came out, kind of fell by the wayside just given the big banks. But we should mention they talked about a lower cost of care potentially helping their bottom line as well. But let's talk about the rates picture because at the end of the day, there is one question and one question only that is likely driving these markets. In 2 weeks, about 2 weeks, a week and a half, let's say, the next Federal Reserve meeting, 75 basis points or 100, Guy. And right now, those bets for 100 that were so high just a couple of days ago, well, they are coming back down. How much of a difference do those extra 25 basis points actually make? Or do they cause a panic? Guy, we're going to have to find out.
Absolutely. We're going to the quiet period, so we're going to have to figure it out for ourselves over the next few weeks. We do, though, as you say, Kriti has some data to digest, retail sales, but also the UMich number as well. Fed Governor Chris Waller backing raising rates by 75 basis points later this month. This after the hot inflation report. He spoke to Bloomberg's Mike McKee yesterday.
I fully support another 75 basis point increase. However, my base case for July depends on incoming data. We have important data releases on retail sales and housing and inflation expectations coming in before the next meeting. If that data come in materially stronger than expected, it would make me lean towards a larger hike at the July meeting.
Got some of those numbers now? We've digested them. We've figured out potentially what they mean. The University of Michigan data I thought was fascinating, dropping on the 5 to 10-year inflation outlook to a one-year low. So can Chris Waller relax? Let's talk about that. Fed Governor Randy Kroszner joining us now. He is a professor at the University of Chicago Booth School of Business. Randy, great to have you on the program. Chris Waller talking about the fact that he wants to go 75. He's keeping an eye on the data. We've got some of that data. Inflation expectations seem to actually be dropping further out, judging by the University of Michigan data.
So that's going to help Chris to relax, which I think is a good thing for all of us, because the key thing that the Fed worries about and that we all worry about is inflation expectations becoming unanchored. So we saw a tick up last month, and if that continued to tick up, that meant that people are losing faith in the Fed. They're losing faith in Jay Powell and his colleagues, and that would mean that the Fed would have to drive rates even higher. So I think not that they can totally relax, but because I think they need to go 75 at the next meeting. But I think this will be consistent with that rather than a push towards a full percentage point at the next meeting.
Why not, Randy, go 100?
Well, if inflation expectations are starting to move down, and the economy still seems to be reasonably strong. I think we're seeing a little bit of signs of slight weakness, potential slight weakening in the labor market, but the consumer is still making purchases. That's a good situation for the Fed to be moving expeditiously, but not moving too quickly, because inflation expectations are starting to come down.
Let's talk about the yield curve and how good a signal it is. Jim Bullard's been speaking as well over the last few minutes. He said this: I take the yield curve inversion seriously as a signal, but I think this time is different. We've heard those words before, haven't we, on the yield curve. And the reason for that is that if we had inflation at 2%, it would be a serious signal. But inflation where it is now, a little less so. Randy, what do you make of that?
Well, you always have to take yield curve inversion with a grain of salt. The joke among economists is that yield curve inversion predicts 10 of the last 5 recessions. So it inverts, and it doesn't necessarily mean that there will be a recession. It does typically precede a recession, but it sometimes inverts when we don't have one. So I think, sort of along the lines of what Jim was talking about, you've got high inflation now. You've got the Fed moving now, which they need to be moving. But the markets have not had inflation expectations get out of control. They're expecting inflation to be, at the upper end of the long-term range that they've been expecting for a while. I think they see an economic slowdown, potentially a recession, and they see the Fed over, let's say, a couple-year horizon being able to bring inflation back down. Maybe not exactly to 2%, but at least to, let's say, 2.5 to 3.
Randy, I'm just really struck by the narrative change in the last 24 hours. I mean, yesterday it was really like the Fed really needs to go 100. The market's giving them a green light to go 100. And now we really are walking that quite back. And I'm wondering, do we get to the 4% that Bullard was talking about? If we get to 4% by the end of the year and we stay there, what does that do? What does that look like? The markets don't seem to be pricing something like that into the market yet.
So certainly, I think that it's likely that the Fed will get to the 3.5 to 4% range, unless there's some sort of major shock. And of course, there's an enormous amount of uncertainty related to war, sanctions, geopolitical tensions. So there could be something else that intervenes. But I think, given their, where they think the economy is going, and if it goes in that direction, they'll be, so certainly they'll be in a tightening part of the cycle. The unemployment rate is going to go up. I know people don't think the unemployment rate can go up, but given the tightness of the job market, but I think that it will. And that is going to be doing part of the job for the Fed also. As the unemployment rate goes up, there'll be lower demand. Certainly with higher interest rates, that's having an impact on the housing markets, having an impact on investment. And so you're going to have this kind of 1-2 punch of a slowing economy and the Fed taking credit away, and so I think that they'll get to that range, and then hopefully it'll just be a relatively soft landing. But there's a lot of uncertainty about that. Right now, the markets are anticipating more softness in the landing, so they seem to be buying the Fed's line. We'll just have to see. This is really quite unusual.
As you say, there are certain things that could knock the Fed off course. And we look outside the United States as much as anything else for those potential sources. How do you think that the slowdown in China, and we saw the data today, incredibly weak, and the slowdown in Europe, the data and the forecasts incredibly weak and could potentially get weaker, are impacting the US economy and the Fed's thinking right now?
So 2 aspects of it. One, significant slowdown in Asia and in Europe means lower global demand for commodities, and so that will be a help to the Fed to try to reduce some of the inflation pressures. It's something that is negative because, of course, there'll be less demand for U.S. exports. The U.S., I think, is in a much stronger position than in either of those regions, and I think that's one of the reasons why the Fed feels that it can move rates up so much more than the other regions are without necessarily triggering a recession, but certainly there's going to be a slowdown.
Not here, but elsewhere, especially other emerging markets, Randy, it's looking really hard to manage the stronger dollar and a hawkish Fed, right? We saw the Chilean peso was up 5%. The central bank had to announce an intervention. We've seen big hikes there. And I have to wonder if the Fed is able to get to 4% and stay there because our economy is strong enough. What happens to other economies and other central banks? How are they going to manage something like this? That feels like a world where we haven't been in quite a long time.
I think you're exactly right. And this is a major challenge because all central banks have a mandate from their parliaments or their congresses to focus primarily on the domestic economy, just like the Fed is. Obviously, this is going to have knock-on consequences for other countries. As you mentioned, Chile, they were at about 50 basis points about a year ago, and now they're at like 8 or 9%. So it's forcing central banks in other countries to move expeditiously. The dollar is strengthening quite significantly. And also, whenever there's global uncertainty, people run to the dollar. So you get a combination of higher yields in the U.S. relative to a lot of other countries and the uncertainty. So that dollar is going to continue to be strong. Other central banks are going to be having to catch up. The challenge for countries emerging market countries that have a lot of debt outstanding, especially dollar-denominated debt, is it's going to be really tough to pay that off. And so there's going to be a fiscal contraction in those countries and probably a sharper slowdown than in the U.S.
Does something break here, Randy? We've seen it in the past where the Fed has had to react to big external shocks. Russia, China, the devaluation, there have been incidences where the Fed has been blown off course. How high would you say the risk is here?
Well, I think given all the geopolitical uncertainties, given the war and the sanctions and continuing tensions with China, the probability that there's going to be some sort of major global issue seems relatively elevated right now compared with history. So I think there is a chance that there could be some sort of shock that causes the Fed to pause.
Mm-hmm.
But it's very hard to know exactly what that'll be.
Yeah, especially if inflation keeps heading higher. Hey, Randy, last question, and this is more a Europe question. They are facing some crises along many different fronts. If the ECB is going to go, if the Fed's going to go 75 and you're looking at 4% by the end of the year, what does the ECB do at that point? Can they hike as much as they need to?
So the ECB needs to get going. They have quite a bit of inflation and they're facing more pressures from Russian oil and natural gas issues, but they also have much greater chance of recession because the energy prices being higher, and so I think they're in a much more difficult position than the Fed. I think the underlying strength of the U.S. economy is greater than the underlying strength of the European economy. But they have to worry about inflation expectations getting out of control, so they need to move. Unfortunately, I think they've moved even slower than the Fed has moved, and so that, I think, makes it more likely that they're going to have the 1-2 punch of all of these shocks slowing their economy down, plus ECB tightening. But they've got to move because otherwise inflation expectations could get out of control.
Yeah, it's going to be brutal. That Thursday day next week, key. All right, Randy, thanks a lot. We really appreciate you spending so much time with us today. Randa Krosner, a University of Chicago Booth School of Business professor and former Fed governor. Thank you so much. Well, coming up, you got Citi shares rallying over 10%. This is the most we've seen since November 2020. We're going to speak with a money manager who owns bank names, Cole Smead, Smead Capital Management president. This is Bloomberg.
Find answers now.
Keeping you up to date with news from around the world, here's the first word. I'm Rishika Gupta. President Biden travels to Saudi Arabia today. Bloomberg's learned he'll leave the Middle East without any public announcements on increasing oil supply. The president hoped to come away with something that could help curb soaring gasoline prices. The president meets with Saudi Crown Prince Mohammed bin Salman today. He'll talk with other leaders from the oil-exporting Persian Gulf on Saturday. In the UK, the race to succeed Boris Johnson as Conservative Party leader and Prime Minister goes on TV. The 5 remaining candidates will face off in a televised debate. Former Chancellor Rishi Sunak and Trade Minister Penny Mordaunt pulled ahead of their rivals in the second round of voting Thursday. The next ballot comes Monday. Global News 24 hours a day on air and on Bloomberg Quick Take, powered